Here's something that surprises almost every retiree I meet. You may actually pay less in taxes during retirement than you did while working, even if you're pulling six figures in retirement income. Most people, they assume the opposite. They hear things like RMDs are going to crush you, or the government's going to take half of your IRA. You know that, don't you? But when I sit down and run the numbers, the truth actually shocks them. In retirement, your income changes, and so do the rules that decide how much of it the IRS gets to keep. And once you understand how retirement income is taxed, you realize something powerful. You have more control over your taxes in retirement than you ever had while you were working. Hi, I'm Mark Wisniewski, President of Southern Incomes. If you find this helpful, don't forget to like and subscribe. And if you'd like to see how much control you actually have over your own retirement taxes, there's a link in the description where you can book a call with me. Now, let's walk through why so many retirees end up paying far less in taxes than they expect, and how to make sure you're one of them. When you stop working, your earned income, that's the kind that gets taxed at the highest rates, it disappears. Instead of a W-2, your income now comes in the form of things like, well, Social Security, withdrawals from IRAs or 401ks, investment income, and possibly Roth or other tax-free sources. Each of those is taxed differently, and when you blend them strategically, your overall taxable income usually drops dramatically. Let's say you need $90,000 to live on in retirement. After accounting for standard deductions and how Social Security is taxed, you may only owe tax on roughly $55,000 or $60,000 of that. That's why many retirees find themselves with effective tax rates of around 10 to 12%, not the 25, 30, or 35% that they paid during their careers. Social Security is not fully taxable. This is where most people get it wrong. Only part of your Social Security is taxable, and that percentage depends on something called your provisional income. What's that? Well, it's a formula that includes half of your Social Security benefit plus your other income. And for many retirees, only 50 to 85% of benefits are taxable. And with smart planning, you can often keep it closer to the lower end of that range. For example, if you receive, say, $40,000 in Social Security and you draw another $40,000 from Roth or other tax-free sources, your provisional income may stay low enough that most of your Social Security remains untaxed. But if you take that same $40,000 from a traditional IRA instead, your taxable income, and for that matter, your Social Security taxation, could double. That's why tax diversification is so important. Having both taxable and tax-free income sources gives you options each year to control your bracket. The standard deduction does the heavy lifting. Here's a number that surprises a lot of people. In 2025, a married couple over 65 gets a standard deduction of over $30,000. That means the first $30,000 of income you earn is automatically tax-free. So if you're bringing in that $90,000 in total income from your Social Security, IRA withdrawals, and other investments, your taxable income might drop to around $60,000. That's a huge reason why many retirees pay a lower effective tax rate. And here's the next level. What if you intentionally fill those lower tax brackets by doing partial Roth conversions? You can move money from your IRA to a Roth each year on purpose, while staying within that 12 to 22% bracket, locking in today's lower rates and avoiding higher rates that await you later in retirement. That's what I call the tax bracket optimization. It's one of the best tools retirees have for keeping more of their income longer term. You decide when and how you pay taxes. During your career, the IRS decided it for you. Every paycheck, taxes withheld automatically. But in retirement, you're in control. You decide when to take income, where it comes from, and how much of it is going to be taxable. You can delay Social Security to age 70, take from taxable accounts first, or draw from Roths to keep income below key thresholds. You can even time withdrawals to avoid Medicare RMDs surcharges, or minimize the tax on your Social Security benefits. In other words, taxes in retirement are not fixed, they're flexible. And that flexibility is what allows smart planning to work for you. Roth accounts, the game changer. Here's where the long-term tax control really shines. Roth IRAs. Money inside a Roth grows tax-free and can also be withdrawn tax-free. That means it doesn't count towards your taxable income, your IRMAA limits, or your Social Security tax calculation. If you've been strategically converting or even contributing to a Roth IRA all along the way, you've created a source of tax-free income that can dramatically lower your lifetime tax bill. Think of your Roth like a pressure valve. When you need extra income in a given year, you can pull from it without bumping yourself into higher and higher tax brackets. That's how retirees maintain consistency and control. No surprises, no spikes, just smart income coordination. For example, let's say you're a married couple, both 67, and you need, we'll say you need $100,000 in total income. Well, here's one possible breakdown. $45,000 comes from Social Security. Another $30,000 comes from IRA withdrawals. And the remaining $25,000, well, that comes from Roth IRAs and other after-tax investments. But after accounting for standard deductions and how only part of your Social Security is taxable, your taxable income might only be around $65,000. Your total federal tax bill, I'd say roughly $7,000 to $8,000, leaving you with an effective rate of around 11%. Compare that to your working years when you were earning $180,000, $200,000, or $250,000 and you paid 22, 25, or 35% in taxes or even more. You're living on six figures, but paying about half the tax you used to. That's not luck, that is planning. The real lesson, you control the game. Here's what I tell every retiree I talk to. The single biggest factor in your retirement tax bill is not the IRS. It is your strategy. Most people go through life letting taxes happen to them. They earn income, they pay what's owed, and they move on. But in retirement, you have the unique ability to decide when you recognize income, where that income comes from, and how much of it is even taxable. That's incredible leverage. It means you can build your withdrawals around your tax bracket, taking more when taxes are low and holding back when those rates go higher. You can do small annual Roth conversions to smooth out your future RMDs and prevent bracket jumps later on. You can even coordinate your charitable giving to offset taxable withdrawals through qualified charitable distributions, or QCDs. The key is all of these moves are intentional. They're not reactive. And that's the difference between someone who hopes taxes won't be too bad to someone who knows what they're paying. It's the least legally possible. When you build your income plan around the tax code instead of after it already happened, you stop guessing and you start controlling the outcome. That's why so many retirees who used to fear RMDs or higher taxes later in retirement are now paying less than ever. They've learned that the tax system rewards their planning, not last-minute panic. The bottom line is this: retirement taxes are not something to fear. They're something to manage. And with the right planning, you may be shocked at how low your taxes can actually be. Because when you stop thinking like a taxpayer and start thinking like a strategist, everything changes. You stop letting the IRS dictate your income and start designing your retirement on your terms. If you'd like to see how this could work in your own life, how much income you can generate, how to stay in those lower brackets, and how to keep more of what you've earned, book a call with me using the link in the description. We'll walk through your current accounts, your income needs, and your tax situation, and I'll show you how to coordinate all of it into a clear, tax-smart retirement plan. I'm Mark Wisniewski, President of Southern Incomes. Thanks for watching. And remember, retirement isn't just about how much you've saved. It is about how much of it you get to keep.